What are some big mistakes that you see buyers do during the escrow period?
The main things, like, we have to prove that you have the ability to repay this loan. And we prove that by your looking at your credit, your assets, your money, and your income.
What is the best advice you would give to a first-time home buyer?
A, like, can you qualify? B, how much you can qualify for? And C, like, is this going to be a financial fit for you? Like, what is your monthly payment going to look like?
In Washington and Oregon, is there a minimum credit score that you have to qualify for a loan? Can you get a loan without a credit score?
Credit score is usually not determined by state. It's typically defined by loan programs. You're going to have a better credit score if you can show that you've paid your bills on time without missing payments for a longer period of time. That's one of the biggest factors of your credit score. The other is like, what is the balance in your credit cards versus the total limit?
You hear the terms pre-qualification and pre-approval often. What do those mean, and what is the difference between the two?
Let's say someone were to call me and tell me, okay, I make $80,000 a year and I have 740 credit score and I have $300 auto payment and $100 in credit card payment. And then I'd be like, oh, okay, that sounds great. Based on what you've told me, let me ask you a few questions about your employment history. And then based on what you've told me, I think I can pre-qualify you for this amount.
Hi friends, it's Jasmine, your Vancouver, Washington Realtor extraordinaire. I help people buy and sell homes all over Southwest Washington and the Portland metro area. And today we're doing a little bit of a different video. This video is going to be sit-down interview style with Jordan Lee.
Hi.
He is a mortgage lender and also is a part of AREAA, which is the Asian Real Estate Association of America.
Yeah.
You are a board member, correct?
Yeah. Well, I'm actually more in an advisory role now. I've served on the board for about 6 years and held the president office and kind of past president office. And now I'm kind of matriculated into a advisory role so I can kind of help let other people take the wings.
Awesome.
Yeah.
So I wanted to bring Jordan on because I work with a lot of first-time home buyers and a lot of people that have questions about mortgages. And Jordan is a wealth of knowledge. So I have some questions here that I'm going to start asking him. First, we're going to start getting to know Jordan. Do you mind telling us a little bit about yourself, why you got into real estate and mortgage lending?
Sure. I've been a mortgage lender for about 10 years now. I started as a cook in the area. So I went to culinary school in Portland and then worked in that field for about 6 years before I kind of got to the point where I was realizing that it didn't align with what I wanted for my family and my kind of financial future. Just I didn't find a good work-life balance there.
Right.
And I'd always been interested in finance and building passive income through real estate. So I thought kind of about, well, maybe I'll figure out how to do this for myself and help my friends and family do the same thing along the way. And I actually had a really good experience when I bought my first house back in 2012, that was. And so I reached out to the mortgage broker that helped me with my loan, and she worked for a local Portland company. And so then I talked to her, figured out how to get licensed, and then worked with her for about a year. And I still work with the same folks. She's my colleague now, but I've been doing more loans ever since. And then I do a little bit of like real estate investing and development as well on the side.
Interesting. Okay. Where are you based primarily? Where do you do loans?
Sure. I mean, the great thing about doing loans is that it's all over the phone and the computer. So like, I've done loans in South Dakota, I've done loans in Florida, I'm doing loans in Texas right now, but my office is in South Portland waterfront area, but we're licensed in about 10 states and really I can do like commercial and investment properties in pretty much the whole country.
Awesome. Okay.
Yeah.
What kind of clients do you feel like you're best at helping, and what do you love most about helping them?
Well, I think the most rewarding is always, people that are first-time home buyers, especially folks that, it's like kind of a big step for them that are not really sure if they can qualify or like just don't really understand the mechanics of it. Because I love the educational piece. My parents always said that they thought I'd be a teacher, but I tried that and I didn't. Hats off to teachers out there. It's a really hard profession. So I think the educational part's really rewarding. So I do love working with first-time home buyers. And then I've also kind of found that first-time investors are a client base that I resonate well with because, I kind of moved into that space recently within the last 5 years and did so using equity from the first home that I bought.
Interesting.
And, it took me about 8 years to get to that point, but then I was able to kind of take a HELOC on that and use that as the down payment to buy my current home and the kind of sort of like main home that we're going to be in while we raise our kids and put them through school. So I was able to do that with what felt like I was cheating, right? Because I didn't save any money for down payment. I just used the equity. And then I have a tenant in my old home that's now paying both my first mortgage and the second mortgage that I took out to buy the new home, and it's cash flowing a little bit.
That's amazing.
And which is a strategy that I've always heard of and like read about and advised people to do, but it's totally different when you actually do it yourself.
Exactly. Like taking equity from your home and then using it to purchase another home and vice versa. You brought up first-time home buyers, and I know a lot of first-time home buyers are so overwhelmed and don't know where to start.
Yeah.
Would you recommend that first-time home buyers talk to a mortgage lender first or talk to an agent first? Like, what is the best advice you would give to a first-time home buyer?
I think that's a great question, and I think most of the time, first-time home buyers will end up talking to a realtor first, even though that might not be the most logical first step. I think realtors are great because they'll get you excited, they'll help you like understand the process and the steps, and like it's kind of like the hype man versus the accountant, right? Yeah. Whereas the for my job is to kind of figure out for first-time home buyers, like, can you qualify? B, how much you can qualify for? And C, like, is this going to be a financial fit for you? Like, what is your monthly payment going to look like?
Definitely.
How much cash are you going to need to come out of pocket with? Is there like other sources? Like, can you get a gift from a family member? What kind of program fits with you? Or, if what's your credit score look like? What kind of program does that put you in? Are there things that you can do to improve your credit to help you qualify for a different program? Or, all those kind of questions that are a little bit maybe just amorphous for a first-time home buyer. I help you kind of like clarify those things in your journey.
Yeah, definitely. And I think as a realtor as well, when I get first-time home buyers reach out to me, I always try to point them in the direction of a mortgage lender first because I wouldn't know what you qualify for. So I wouldn't even know what home price point to send until my buyers have spoken to a mortgage lender. So moving on from that, you hear the terms pre-qualification and pre-approval often. What do those mean and what is the difference between the two?
Yeah, I mean, I think for the general public, like a pre-qualification and a pre-approval can kind of be the same thing. We do have this weird terminology, and almost I would say that I've written like less than 5 pre-qualification letters in my career. And what I would say, like the actual technical differences between a pre-qualification and pre-approval is like, let's say someone were to call me and tell me, okay, I make $80,000 a year and I have a 740 credit score and I have $300 auto payment and, about $100 in credit card payment. And then I'd be like, oh, okay, that sounds great. Based on what you've told me, let me ask you a few questions about your employment history. And then based on what you've told me, I think I can pre-qualify you for this amount. And that's sort of all it is. It's like we've talked.
Yeah.
I think I can qualify you for this amount. Versus a pre-approval, which is standard in our market and in most markets now, is where, we have a conversation or, like some emails back and forth, and then I collect actual documentation of what your employment history looks like, what your current pay stubs and income look like, or tax returns if you're self-employed. And then I look at your credit, I pull your credit score, look at your funds available for down payment. So I look at bank statements, and then run it through our automated underwriting system to pre-approve and show that what exactly I can actually qualify you for and know that I can deliver a loans. And that's ultimately what the seller wants, right? That's the confidence the seller wants when they see the offer. They want to know that something's been looked at by a third party and that you'll be able to get that loan that you're looking for to buy the house that you can qualify.
Got it.
But I think sometimes people confuse, like, for the general public, like pre-qualified, I'm qualifying you for a mortgage.
Got it. Okay.
Yeah.
If someone is going to be coming to chat with you, what are some of the things you think they should have just right off the bat?
Yeah, I mean, great question. I mean, usually the first conversation is sort of like we call it the hopes and dreams call. Like, okay, what are you trying to do? Like, are you buying the house that is gonna be a stepping stone for you? And then in 3 and 5 years from now, maybe you're going to sell that and move into a bigger house, or maybe you're thinking about building a rental property. So maybe you want to, get a house with an ADU or a duplex or something to start that you can have one of your friends team up with you. I guess that first part is to kind of figure out that, do we align in terms of the way we communicate and kind of our values and sort of what your long-term plan is. So, I mean, really, you don't have to really prepare anything for a first time call.
Mhm.
I am going to ask you questions about what your employment history is, what your income is, what your credit looks like, what your debts look like. So, I mean, I think for anyone, in general, it's a good idea to have to know how much money you make and and what your monthly kind of debts are and credit score. But I mean, credit score is kind of like you don't really need to know that. And I think some people put a lot of emphasis on that. I think what's more important is like, are you paying your debts on time? And what are your debt balances like and what you're doing with that? So, I mean, ultimately, just like a kind of understanding of what your current financial picture is what I'm going to be trying to suss out before we kind of move forward with the next application part. Because sometimes the responses I get from those questions influence like the actual documents that I'll need to do the full pre-approval.
Gotcha. I think a lot of people feel deterred from the market because they feel like they have to have 20% down before they even think about purchasing a home. Is that something that's true, or are there ways you can go about it in a different way?
Yeah, it's amazing. It's been like over 50 years that there's been programs where you can put less than 20% down. And I think still like half the population, general population, probably doesn't realize that you can put on a conventional loan, you can put as little as 3% down. On an FHA, you can put as little as 3.5% down as first time home buyers. And there are programs, especially in Oregon and Washington, that allow you to put less than that.
Mm.
And so yeah, that 20% is a misnomer. And I think for first time home buyer, that's not common to put 20% down. And even my folks that can, oftentimes it's a stretch. And when we look at the difference between putting 15 and 20% down,
Mhm.
I would say 8 times out of 10, the folks will put 15% down because the rate's the same, or maybe sometimes even slightly better at 15% down.
Mm.
And mortgage insurance is really affordable. And, 5% of a $400,000 home's $20,000 difference on
Yeah.
front, which can be quite a big difference if you're like putting all your chips in to buy that first house.
Got it. So, since we're focusing primarily on Washington and Oregon, in Washington and Oregon, is there a minimum credit score that you have to qualify for a loan? Can you get a loan without a credit score?
These are great questions. So the credit score is usually not determined by state.
Mhm.
It's typically defined by loan programs. So for conventional loan program, which is like your standard vanilla programs, there is a minimum credit score requirement of 620, but FHA doesn't actually have a posted minimum credit score.
Got it.
So you could have a credit score in the mid. I've had approvals at the mid 500s credit score in like the 550s range. Though when that because there's a back end automated algorithm that looks at it. So it's going to look for compensating factors like, is there strong income? Are you just recently recovering from a bankruptcy? Like, what's causing the lower credit score? Maybe you're just building credit. And yeah, to your point of having no credit, there are options if you're what's called a credit ghost. Sometimes people refer to it. It's just somebody that hasn't decided to get credit cards and paid for everything with a debit or
Yeah.
cash. In that circumstance, you can qualify for a mortgage. You might have to have a little bit worse terms, but what we do to kind of like, because essentially what credit is, this number that represents your ability to pay your bills, right? So, you're going to have a better credit score if you can show that you've paid your bills on time without missing payments for a longer period of time. That's one of the biggest factors of your credit score. The other is like, what is the balance in your credit cards versus the total limit? And then just like being able to show that you can do it on multiple scenarios, right? So, in order for us to like essentially the lender is using a credit score to be like, okay, are they going to make their payment, right? And so in order for us to do that, if you have no credit history at all, what we're going to look at are things like, do you have history of paying rent,
Mhm.
right? So have you paid rent to your landlord for the last 12 months? And can we verify that with, either bank statements or your landlord signing off on a document that states that? Yeah, another thing could be you could verify with cell phone bills, insurance bills, like a car auto insurance type bill, like something like Netflix or one of those streaming services or cable bill. So we can do that. It's just going to be a little bit more onerous in terms of documentation, but it's definitely possible.
Perfect. You have brought up different terms like FHA, conventional, VA. Do you mind explaining the difference between these types of?
Yes. Yeah. Sorry. Great question. There's so many acronyms in mortgage. I remember when I first started, it was like every day I'd go home with a headache because I was like trying to learn, and it reminded me of taking Chinese my first year in college. So yeah, I learned a new language. But yeah, so loan wise, conventional is sort of the most common loan, right? That's the standard government backed mortgage based securities. I guess you wouldn't say they're government backed. They're backed by Fannie and Freddie, who is in government conservatorship. So in a sense, they are kind of government backed, but it's the most common loan. They're securitized on a secondary market, and they're really standard, and they offer very preferable rates, especially for primary and investment right now too. They're made to individuals. You're not made to an LLC. It's kind of the most common vanilla loan. Then you've got your FHA loan, which is through the Federal Housing Administration. And those loans, they're what we call a government loan. And those are only for primary. Like you can't use those for investment property. And you can't really have multiple of them unless you're like moving across the country. Then they'll allow you to do that. I think the rule is if you're buying a new home, it has to be more than 100 miles away to be able to use another FHA loan. So it's a really great benefit. It's considered kind of like a government benefit in a way for folks. The FHA is great when you're buying like when you have low credit or you're recovering from a bankruptcy. FHA is the best option. If you're, buying a duplex, you can put 3.5% down,
Gotcha.
which is which I find clients use a lot. Yeah, I'm doing FHA for folks with lower credit scores or buying a duplex is kind of where I find that or recovering credit scores, or that's kind of the main bucket that I'm finding people use FHA loans. Sometimes they like qualification wise, it can make more sense to go FHA just for various reasons, but they also have a little bit more mortgage insurance premium on them.
Yeah.
So oftentimes people, if they can, they'll go for conventional, but it sort of depends on your situation. And I always like to show people their options. Now, you mentioned VA, that's a Veterans Administration loan. So though that's another government loan and it's a benefit for folks that have served the country. In my opinion, it's the best loan that there is. You can put zero down. It's a really excellent rate. You don't have to pay monthly mortgage insurance, but they do have an insurance premium built into the upfront. Like it's just added onto the back end of your loan. So you put zero down. Let's say you're buying a $300,000 home. Instead of your loan being $300,000, it might be $306,000. But it depends. Like if you can get an exemption from that if you have a military disability. So the VA loan's great. Again, it's like I think it's the best loan that there is, and it's a really great program. And then there's USDA. It's not as common in this area because you got to be in what's considered a rural area. It's also a really great loan. You can put zero down, really great benefit, but you have to have it's limited on the amount of income you can make, but then also the debt to income ratio is a little bit tighter. So it works really well for folks that have like a larger family, like 3 to 4 folks or more
Mhm.
in the family, and then a moderate income earner in a rural area is sort of the profile for a USDA loan. But the great option. It's limited in the scope because there's only certain areas that you can do it.
Gotcha. So I know before we sat down and chatted, we spoke briefly about interest rates.
Yeah.
And I know you said it's hard to really quote an interest rate. But right now, currently in 2025, what has it been hovering around for the most part? And when it comes to interest rates, are there different scenarios you can do to make it less than what it is?
Sure.
Different strategies?
Great question. So there's always this kind of when the public hears about interest rates, there's a little bit of a divide, right? Because there's mortgage rates or long-term rates are different than the federal funds rate or the short-term rate that banks lend each other money at. And oftentimes what we're hearing about in economic news is, oh, the Fed's thinking about lowering their interest rate. And while the federal funds rate does impact mortgage rates in a sense that what the Fed does and how they act will change mortgage rates, they're not in like lockstep. Like if you look at a graph with the Fed funds rate versus mortgage rates, they're not going to be direct correlation. I mean, there's some in the longer term form, but it's not like, okay, the Fed lowers their rate, mortgage rates goes down. It's just, that's not the kind of causal relationship that they have. But yeah, I mean, mortgage rates essentially, a lot of us remember that, during this brief period of 2018 to 2021, we were in a really, really low rate environment, historically low, right? We were writing mortgages that had a two in front of them, which is like unheard of. And even if you like average that in, if you go back the last 55 years and in average mortgage rates, you're going to be in the mid sevens, around 7.5%. If you look back over 55 years. So a lot of times we have short-term memory, right? Like when I first got in the industry, a lot of us had short-term memory of this 2008 cycle where, yeah, after the mortgage crisis, the rates were, and not only were rates a little bit lower, but like prices dropped significantly. And so everyone was kind of like in the back of their mind, they're like, okay, I'm just going to wait until that happens again. I'm wait until that happens again. And now our short-term memory is, okay, the rates were lower. But the thing we don't remember about that is that prices also skyrocketed when rates were lower because there were so many more people that could buy and just like so much more interest, right? Because prices are ultimately determined by supply and demand. But yeah, to answer your question a little bit more directly, and since COVID, since rates have gone up in 2022 to now, we've been oscillating in this range of between 6% and 8% on just like a standard 30-year fixed conventional loan with 740 credit score via primary residence. At the worst over the last 3+ year period, it's been as high as almost 8%, and then as low as about 6. I haven't been writing mortgages in the fives except for folks that are paying significant points.
Yeah.
Like doing a 15-year fix, 15 years a little bit lower, September 2025, and we happen to be in kind of the best rate position we've been in the last couple years. So we're kind of getting again close to that low sixes range for a primary resident 30-year fix. Yeah.
You brought up paying points.
Uh-huh.
What does that mean?
Oh, paying points is like yeah, so we call when I look at a rate sheet, or like if someone asks me what the rate is, and it's just such a different thing from what the public sees versus what I see, right? So when I'm pricing something out, I look at a rate. I've got rates from as low as like 4.5% to as high as like 8%, right? So, and you can move up and down that sheet and choose, right? So we call that premium pricing. So for example, let's say just for numbers sake, let's say what we call the par rate, or a rate with no additional fees or costs, was 6.5%, right? You could also choose to get 6% and maybe pay 1.5% of the loan amount to get that rate, right? So up front, your closing costs would go up. Let's say it was a $400,000 loan, your closing costs would go up by $6,000. And then instead of getting a 6.5% rate, you get a 6% rate, and it would lower your monthly payment by, whatever, somewhere in the $150 neighborhood. And, over the 30-year span of your loan, you'd probably save about, $40,000 or something like that. I'm just throwing out a number to like, you'd have significant savings over time, but there'd be a period at the beginning of the loan where you're not seeing that return on investment. So typically I advise folks, if you're paying discount points to get that lower rate, I would only do that if you don't think you're going to sell or refinance in the next 3 to 5 years. Now, on the flip side, you could also decide, instead of taking 6.5%, you could take 7%. Why would you want to take a higher rate? Well, just like you can pay more to get a lower rate, you can also pay less or get a credit towards your closing costs and take a higher rate. So, for example, I had a client that purchased in Santa Cruz not too long ago, and they had gotten an equity payout, and so they were like buying this, big home, I think the loan amount was like 600,000 or something, and they had a huge down payment. I think it was 1.8 or something like that. But they were telling me like, hey, we're gonna get another equity payout from our company in the next like 7 months. We're eventually gonna pay off this loan because our current mortgage we have a low rate on, so we'll just keep that, rent our house out, and get rid of this mortgage. And I was like, oh, okay. Well, why don't we raise the rate on your property? And since you're going to pay it off in 6 months, you'll get a credit back about $7,500 at closing. It'll essentially pay for all of your closing costs. And then you'll just have like, a few hundred extra dollars per month payment, and then you pay it off. So that's the kind of the math that I'm interested in, because it's like everyone's very caught up on, I want to get the lowest rate. I want to get the lowest rate, but what is that lowest rate costing you?
Exactly.
And what is your like long-term plan? Like, are you gonna just refinance in 2 years? Then don't go for that lowest rate, right? Take the higher rate. So yeah, essentially that's what's interesting to me, the math behind that. And I think I consider it my job to kind of help help people figure out, because I see part of your financial picture, but I don't see the whole thing.
Mhm.
And so I want people to be able to understand that so they can make an informed decision.
Got it. You had brought up refinancing a couple times.
Yeah.
For those who don't know what refinancing is, what exactly is that?
So I like to talk about refinancing. My brother, one time I helped my brother refinance, and he's like, "Wait, so you're telling me I can lower my payment by $300 a month, and I'm getting money back?" And yeah, like, what is going on? I'm gonna miss a payment. Like, what's going on here? This is a scam. Like, even though like the day before signing, he's like, "Are you sure you're not scamming me?" But, refinance is interesting. And then afterwards, he's like, "Well, yeah, Jordan's helped me, made me buy my home twice." But essentially, what you're doing with a refinance is you are taking a new loan out and paying off your old loan and getting a new loan. And when I first got into the industry, I was like, why would I ever want to do that? Especially if I've already been paying on that loan for like 5 years or 3 years or whatever it is. Why would I want to start my term over? And what kind of there's a couple of things that made the difference for me, but what kind of made the real switch to made it make sense to me was when did the math. Like, I looked at the math behind it. So like what I always like to show people is, okay, here's what you can do if you refinance. If you pay a little bit of points, here's what your rate looks like. If you don't pay points, if you do a new cost, I show a few options, right? But the metric that I always like to look at is like, okay, so here's your current loan, here's your current monthly payment. What if we refinance and you keep making that same monthly payment that you were making before? Will you pay off this new loan faster? And during when wage rates dropped, sometimes people would pay, like, be able to refinance, keep making the payment, and then pay off their loan 5 to 7 years faster.
Mhm.
And in that, to me, that's like, okay, this is a no brainer. We should do it.
Mhm.
Or another time I had a client that was looking at refinancing, and we were going back and forth. And he's like, I might sell. And I'm like, okay, so that's good. It's good to know, like, you might sell. So let's look at what's called a no cost refinance, because I can still like, his rate was 1% or something above market rate. And so instead of lowering his rate by 1%, I lowered his rate by 0.75% and used premium pricing
Interesting.
and did a no cost refinance, and added the fees of the refi, like, basically gave him a lender credit for his fees. So he took a little bit higher than market rate, and he kind of hedged. So I was still able to lower his rate, but not as much as he would have if he would have gone for the lower rate. And that way, if he were to sell, he wouldn't feel like he shot himself in the foot.
Yeah.
Turns out after that, rates went up like crazy, and he didn't end up buying a new house in it right away. So it ended up being a good decision for him either way. But it's kind of like those are a couple things. But refinancing is done for lots of other reasons too.
Yeah.
So like, it can't, like, the most people think about it just for lowering your rate, but you also see it so investors will do it to access capital.
Mhm.
If you're inheriting a property, you might do it, right? Like, let's say me and my two brothers all inherited a property, and one of us wanted to, like, take it on, and the others wanted just like, I just want cash. So instead of doing like a purchase and sale agreement, you do what's called a refinance, and then you buy out the other two interested parties, and then you're going to keep the house, and then you use the equity to pay out the other parties that own the property. That's also very common in divorce. So, a divorce decree might say that you are required by the judge to pay about half the equity, whether it's by sale or by refinance. Yeah, I mean, there's other reasons to there's just plenty of reasons to refinance that aren't only to lower your rate. Because everyone thinks that, oh, like, what's the point of refinancing? But, well, sometimes you have to.
Exactly. Let's say a buyer comes into a lot of money and can now pay off their home. Do a lot of these loans have prepayment penalties? And if so, is there a way to get rid of that?
Yeah, great question. So we were talking about conventional loans before and how that's the most common. They're very, like, they have lots of rules and consumer protections. One of the consumer protections of a conventional loan is that there's no prepayment penalty.
Awesome.
Same with FHA loans and VA loans. Pretty much any loan where you're doing on your primary residence, like that you're purchasing for yourself, nowadays, they're not going to have prepayment penalties.
Okay.
There are loans that I do that will have prepayment penalties on investment properties. And that's usually lenders will do that because they're keeping it on their line and they want to protect themselves. They also, like, there's different versions of prepayment penalties too. Like sometimes there's what's called a step down prepayment penalty, or like a 3-2-1, where it'll be a prepayment penalty, 3% the first year, 2% the second year, 1% the third year. So it gets decreasingly worse, increasingly better over time. So yeah, I mean, long story short, most people will never be in a position where they have to deal with prepayment penalties. That's kind of a thing of the past. Like,
Okay.
Your parents or grandparents might tell you to, like, make sure there's no prepayment penalty, but on a primary residence, conventional FHA, VA, all those main loan programs, you're not going to find one unless you're doing some different investment property that's a portfolio loan. Then you might have one.
Gotcha. Okay. Let's move on to buying and selling at the same time. So if someone is trying to sell and buy at the same time, what should they know about their loan options?
Great question. Yeah. This was like really common during 2021 and 2022. Yeah. When everybody was wanting to buy and there was not a ton of supply, a ton of demand. So you would do anything you can to make your offer stronger, right? And most people at that time were trying to trade, right? Because they're like, what's a couple $100 more $1,000? Like, the rates are so low. My payment's probably the same.
Yep.
So, and then if you need the equity from your home, there's a few options, right? So one of those options is called like a bridge, or sometimes it's referred to as a cross collateral loan. It just kind of depends on the lender and what exactly you're doing. But for example, like, I had a client downsizing and they were, moving from Bend to Salem. They had they were retired. They had a $900,000 home that was owned free and clear, and they were buying this $750,000 home. And essentially what the lender was done is, instead of writing an offer contingent on the sale of this, like, Bend home and waiting for the funds to come into their account before being able to buy and extending the contract that way, what the lender will do is put a lien on the Bend home. And then that way they can use extra funds. They don't have to come in with any down payment, and they can buy that new home and without having to put any down payment, without needing the funds from the Bend home. But then when the Bend home sells, the equity from that will come and pay off the loan.
Gotcha.
So the lender is basically, essentially, instead of just collateralizing one, they're collateralizing both, and that's why they call it a cross collateral loan. But there's other things you can do, like you could get a HELOC, a home equity line of credit, and use that to help with your down payment. If you have enough ability to qualify, you can just get another loan
Yeah.
before, but you have to have enough down payment, at least 5% down payment in most circumstances, unless you're getting a HELOC. And you have to be able to qualify for the two mortgages at the same time.
Mm-hmm.
But yeah, those are kind of the main three, really. The bridge or cross collateral. You can get a HELOC, you can pull a HELOC, or you can buy the new home with a HELOC itself if you put 10% down. Yeah, again, you just have to be able to qualify. And there are some options for ignoring the debt from what we call the departing residence as well. You just might have to pay a premium on your rate in terms of the new house. But
Gotcha.
yeah, lots of different options for that.
Yeah, definitely. So let's say we're going back to 2021 or sometime in the future, there's going to be another bidding war.
Yes.
How, as a lender, would you make things stronger for a buyer that is in a bidding war situation? Are there things that you can do to kind of set your buyer apart from other buyers?
Yeah, I mean, of course, agents are kind of in charge of that, the contract terms and sort of like, beyond like, putting X amount of money down or ignoring X amount of inspections, right? From the lending perspective, there are a few things we can do. One, I can check if there's you can get an appraisal waiver, which that could be attractive to the seller. We have a way of doing that. And
Is an appraisal waiver.
yeah, so there's this another kind of amorphous algorithm that looks at the property. It's called Collateral Underwriter, and for the last decade, it's been collecting data. And so, if there's been an appraisal done on a property in the last few years, and the price hasn't escalated a crazy amount, you might be able to get an appraisal waiver if you have strong credentials, and we might not have to do an appraisal. So we can add that in as something. Oh, by the way, we don't have to do an appraisal on this house.
Yeah. Okay.
And because of that, we can close in less than 20 days.
Got it.
So you could add on things like closing time. We can do a 2-week close or that type of thing. We can do what's called a full pre-underwritten conditional approval, where you've actually had the underwriter review everything. All that's left to do is just look at the title report for the property and the appraisal if you need one. So that could help give the seller more confidence. Yeah, we could also do what's called a appraisal gap coverage. So you might be able to say, hey, if this house appraises $50,000 low, we'll be able to qualify up to $50,000 or whatever that number is. And from the lending side, there's ways of doing that. Like the lender will, if the appraisal, let's say the home is worth, sales price is 400 and the appraisal is only 350, we're going to lend on it as if it's 350, but we can do some things like you can put 5% down on that. And maybe you were putting 20% down initially. You can change to a 5% down program and use your extra funds to bridge the gap. So you can still purchase it. And that usually, we can set it up that way as well. And of course I can talk to the listing agent and kind of help them understand how qualified the clients are and what we've done on our side to ensure that we'll be able to deliver the loan on time and that type of thing.
Gotcha. What are some big mistakes that you see buyers do during the escrow period? What are some things that you would advise to not do during that period?
It's funny, you asked that because I've been lending for 10 years and they always talk about don't buy a car, don't change jobs, don't open a bunch of credit cards. And I've had lots of small things happen, but recently I had somebody, they quit their job, right before close. And
Kind of wait till after?
well, yeah, anyway, long story short. And then it was okay, we'll just get you set up with a new job. And then they quit that job too. And so but anyway, that's only happened once to me in the last decade. But yeah, I mean, the main things, we have to approve that you have the ability to repay this loan. And we prove that by your looking at your credit, your assets, your money, your income. So if you do anything that impacts your income with your job, we have to verify that you're still employed up to the day before closing. If you do anything that changes your credit, we have to refresh your credit right before closing. So if you open new credit cards, we're gonna demand new documentation. If you finance something else, if you buy a car, buy furniture, buy any of that stuff, we're gonna have to add that into our debt ratios, and that could if it's tight, that's gonna throw the loan off. Or if it's just getting more documentation, it has to go back through underwriting. It's going to delay you a couple of days, and then the seller might say, "Sorry, you're in breach of contract." And then if we verified money in a specific account, and that money is no longer there because you purchased something else, well, then we're gonna have a problem as well too. So essentially, yeah, you need to keep all of those things the same.
Can you qualify for a loan if you don't have income? What if you have a giant savings and assets, but you don't actually have a job?
Yeah, great question. For the first 5 or 6 years of my career, I would have told you no, but I do have a product that allows you to purchase a home if you have, good, solid credit. I think the minimum credit score is 700.
Okay.
And then if you have 20% down payment, they say, okay, if you're buying a primary residence.
Got it. Okay.
And for investment properties, absolutely, we can qualify you based on whether that property cash flows or not.
Got it. Okay.
Yeah.
Well, we are about to wrap up. I guess my final question for you is, if someone's feeling hesitant about buying right now, what advice would you give them, especially for Washington and Oregon's markets?
I think the market question for me, it like doesn't matter. Like, it doesn't matter what market you're in. Are you hesitant about saving money for retirement? Like, no, you just put that on auto buy, right? Like, every month you just buy. If you're gonna wait for like the perfect time to buy a house, or you're gonna be waiting all your life.
Exactly.
Like, there's always gonna be something that's going to give you a reason not to buy. It's like any project that you want to do, any new hobby that you want to try. "Oh, I need to wait till I have a little bit more time. I want to wait till I have a little bit more money before I have a kid." Well, you can say that anytime, right? And it's the same thing true with buying a house, right? So when you own a house, you're paying yourself every month into your mortgage. You're paying to live, right? But you're also paying into your mortgage, which accumulates over time and is an asset that goes to your retirement. So the longer you wait, essentially you're just depriving yourself of putting money into your retirement in a different way, right? It's, to me, that's my opinion. Of course, I think of real estate as a long-term investment, right? If you're going to buy something and then be bummed out because the price went down for a little bit in the next 3 years, well, I mean, have you held stocks before?
Exactly.
Like, have you ever looked at your 401k or IRA? Like, those things,
Fluctuate all the time.
fluctuate all the time. But, what are we looking at? We're looking at our investment horizon over a longer period of time. And those things, over 10, 20 years, they go up.
Exactly. Well, thank you so much for coming on, Jordan. If people want to find you, what is your social media?
Yeah.
How can they reach you?
Great question. Yeah. Most of my social media is just at Jordan Lee Mortgage. My website's jordanleemortgage.com. Yeah, you can just Google me and find me that way.
And I'll have his info in the links. But thank you guys so much for watching, and I'll see you in the next video. Bye.